Right now, the most valuable companies on earth are racing to sell you their stock. We are talking about more money, bigger names, and higher valuations than anything the stock market has ever seen before. To some people, this looks like the opportunity of a lifetime. The greatest technology boom in history is finally opening its doors to the public. For decades, the best companies stayed private, growing in the dark, completely out of reach for ordinary people. But now, at last, the doors are being thrown wide open, and you get the chance to own a piece of the businesses that could define the next 100 years. But to others, this isn't a celebration at all. It's a trap. And that is the side I am on. By the end of this video, I'm fairly confident you'll be on this side too, because in the stock market, an open door is never a favor. Generosity is never just out of the kindness of someone's heart. It seems like nobody has stopped to consider a basic rule of finance. Every trade needs a counterparty. Every single buyer needs a seller. So, if you're trying to buy a stock, someone else has to be willing to sell it to you. Which means, before you buy what they are selling, there is one simple question worth asking: why are they selling? In an initial public offering, an IPO, the people on the other side of the trade aren't random. They are the founders who built these companies from scratch. They are the early employees who gave them years of their lives. They are the venture capitalists who funded them when they were absolutely nothing. Nobody on earth understands these businesses better than they do. They have seen the real numbers that you and I will never get to see. And they have looked at the most exciting companies of our lifetime. The ones everyone is desperate to own, and they made a decision. They would rather have your cash than their own shares. This is what an IPO actually is. Strip away the headlines and the celebration, and it is a trade with massive information asymmetry. The sellers are the most informed people in the rooms, which means the buyer, by definition, is the least. And right now, that buyer is you. So here's the thought that should be lighting up in the back of your mind, the one that Elon Musk, Sam Altman, and everyone else behind this wave are quietly counting on you not to ask. If these really are the most valuable, most important companies in the world, and the future is as bright as everyone keeps promising, then why are the people who know them best in such a hurry to sell them to you? There is an answer to that question. It is a pattern that has repeated throughout the history of the stock market. It has shown up again and again, right before nearly every major financial bubble pops, and most people have no idea it is sitting right in front of their eyes. I call it the dine and dash. In poker, a tell is a small, unconscious signal that gives away what someone actually believes, no matter what they are saying out loud. Well, financial markets have tells too. They don't come from headlines or earnings calls, and they definitely don't come from the news. They come from watching what people actually do with their money. The average investor sells when they get scared, when the news turns bad or the chart drops, when everyone around them is already running for the door. But the professionals do the exact opposite. As Benjamin Graham, the father of value investing and Warren Buffett's mentor, once said, the intelligent investor is a realist who sells to optimists and buys from pessimists. They sell when everything looks absolutely perfect. When the story is loudest, the optimism is highest, and there is a line of buyers out the door begging to get in. Why? Because that is the exact moment you can get the most money for the thing you are selling. This is exactly what the IPO data shows us. When markets are booming, companies rush to go public and sell shares. But when markets turn south, those IPOs disappear instantly. That is the top being sold to you. Let's look at history. Go back to June of 2007. Wall Street was booming, markets were hot, and the two co-founders of Blackstone, Stephen Schwarzman and Peter Peterson, decided it was time to cash in. They took Blackstone public, and between them, the two co-founders walked away with about $2.6 billion in cold, hard cash. Then, a little over a year later, the global financial crisis hit. The markets crashed, and Blackstone stock plummeted roughly 90%. It's almost like the world's largest asset manager knew exactly when it was time to exit. Or we can go back further to the dot-com bubble. In 1999, the year before the bubble popped, the concentration of tech listings hit a record. Of every company that went public that year, around 51% came from a single sector, technology. The insiders got rich, retail investors thought they were buying the digital future, and then the bubble popped. Over the next 2.5 years, the Nasdaq crashed more than 75%, and an estimated $5 trillion in market value simply evaporated. A study by the Kauffman Foundation and Professor Jay Ritter found that 10 years after going public, only 29% of the emerging growth companies that listed between 1996 and 2000 were still standing as independent companies. The rest were completely gone. Even in 2021, we saw the exact same tell disguise itself as something Wall Street swore was the future, the SPAC, or blank check companies. These were empty shells that raised money from the public to go shopping for a business, skipping the normal IPO scrutiny. In 2021 alone, 613 SPACs went public, raising more than $160 billion. And how did that story end? Companies that completed a SPAC merger in 2021 lost an average of 67% of their value. For 2022, the average loss was 59%. The activity collapsed from 613 SPACs down to just 86. That is the dine and dash. When markets are booming, insiders sell. When they aren't, they don't. So what about AI? Why now? Why are the most valuable companies in the world, who are fierce rivals and agree on almost nothing, all racing to sell you stock at the exact same moment? It comes down to two numbers. The first number is the spending. This year, the largest technology companies on Earth are on track to spend around $725 billion building out artificial intelligence. That is up roughly 77% from the year before. It is the largest and fastest infrastructure build-out in human history. But most people struggle to even imagine how much $725 billion actually is. Let's look at an example to capture the absolute absurdity of this number. If you spent $1 million every single day, starting from the day Jesus was born, all the way through the fall of the Roman Empire, the Middle Ages, the Renaissance, both world wars, and every single day up to right now, you still wouldn't have spent what big tech alone will spend on AI in just one single year. It breaks down to roughly $2 billion a day, $83 million an hour, or about $23,000 every single second. But there is a second number that perfectly sums up the AI industry, and it's a number you probably have never seen before. It is what all that massive spending is actually earning back. The research firm Exponential View put together the first real bottom-up estimate of the entire AI economy. Over the past 12 months, all of it combined generated an estimated $110 billion in revenue. And remember, that is revenue, not profit. Put another way, the entire global AI economy earned back an amount equal to roughly 15% of what big tech alone plans to spend this year. By any business standard on Earth, that is a horrible investment. You might think, wow, well, that's just big tech. Surely it's better for the actual businesses using this technology, but the answer is no. It is actually far worse. Deloitte surveyed more than 3,000 business and IT leaders across 24 countries. They found that 74% of organizations want AI to grow their revenue, but only 20% have actually seen it happen. Another study by researchers at MIT looked closely at hundreds of real corporate AI rollouts, actual companies spending real money. They found that 95% of them produced zero measurable return. Put those numbers side by side, $725 billion going in, and almost nothing coming back out. The massive gap between what is being spent and what is being earned is what nobody seems to be watching. In fact, the market has priced these companies as if that gap doesn't even exist. Take OpenAI, the company sitting right in the eye of the storm. OpenAI is still private, but their financials leaked, and they have filed confidentially to go public, so the picture is completely clear. Last year, OpenAI brought in around $13 billion in revenue. Before you say, that's pretty good, you need to look at the other side. The company nearly tripled that amount in losses. In 2025, OpenAI had a net loss of $38.5 billion. By OpenAI's own internal estimates, they expect to burn well over $100 billion between now and 2029. And here is the cherry on top. On top of all of these horrible financial fundamentals, the valuation is even worse. OpenAI's last funding round valued the company at $852 billion. That is more than 65 times its actual revenue. These aren't smart, calculated bets on whether these are good companies or not. These are wild bets that ride entirely on blind, unyielding optimism. This whole situation reminds me of what goes down as maybe the funniest and most dangerous quote in finance history. One of the people who stood at the very center of the worst financial crisis in modern history admitted a crash was coming, out loud on the record right before everything broke. In the summer of 2007, months before the entire global financial system nearly collapsed, Charles Prince, the CEO of Citigroup at the time, was asked about the bank's continued exposure to highly risky lending and deals, even though the credit markets were starting to look dangerously stretched. His answer became infamous. He said, "When the music stops, in terms of liquidity, things will be complicated, but as long as the music is playing, you've got to get up and dance." We're still dancing. Think about that. He wasn't saying he believed the party would last forever. He actually was saying the exact opposite. He knew it wouldn't. He was saying that as long as the free money was flowing, he was going to keep dancing anyway. Because the second the music stopped, whoever was still left on the floor would be the one who lost everything. Charles Prince understood that underneath all the fancy dancing, it was really just a giant game of hot potato. And the only thing that mattered was making sure you passed the hot potato on to someone else before the music cut out. And that is exactly what you are watching right now in the AI markets. Except this time, the hot potato is stock in an AI company, priced for absolute perfection. The players are the founders and the tech insiders, and they are passing it as fast as they can to the next eager buyer. Every single one of them knows that someone eventually gets left holding it, but none of them know exactly when the passing stops. So the only rational move for them is to hand it off right now to the biggest, most enthusiastic crowd of buyers they can possibly find, the ordinary investors in the United States stock market. So, let's go back to the question I asked at the very beginning of this video. If these really are the most valuable companies in the world and the future is as bright as everyone keeps promising, then why are the people who know them best in such a hurry to sell? Now we can finally answer it. It is because it's the smart thing to do. The people who run these companies are not dumb. They can see the gap. They see that stock prices have sprinted miles ahead of the actual business fundamentals. They know that the market has priced these companies for a future where every single one of these risky bets pays off perfectly. But they are also in the middle of a massive AI arms race, meaning they need deep pockets to keep funding it. An appetite for a bet with a slim chance of ever paying off can only last for so long, which means whoever sells first gets to sell into the hungry crowd. It doesn't actually matter if these companies are good or not. The price already assumed they are perfect. There is virtually no room left for good news and an enormous, terrifying room left for disappointment. Eventually, the fundamentals will catch up. They always do. But I cannot tell you when. I don't have a magic stopwatch that can predict when this bubble pops. I don't know if it's in a month, in a year, or 3 years from now. Nobody knows that. And anyone who stares into a camera, hands you an exact date, and acts like they do know is lying to you. The reality is you don't need the exact date. You just need to be able to read the room. You don't need to know the exact microsecond the music stops to know one thing. You definitely do not want to be the last one on the dance floor when it does. If this video helped you read the room you're standing in, hit that subscribe button. Stay safe. Invest wisely, and I'll see you in the next video.